So, hello everyone. Welcome to this webinar wherein I'm going to talk about how to structure a global entity and what are the complexities around it, how to decode that complexity, how to deal with those complexities. So, uh, the topic is a very broad topic, a humongous topic, a lot of things to cover. But due to the time constraint, I will cover only the important areas, and then if anyone has any doubt, you people can definitely reach out to us through email or by calling us, and we will help you in sorting that out. So I'll start by sharing my screen here. So this is the topic today that we are going to cover. It is structuring global entities, unlocking the complexities. So before I begin, let me introduce myself. Niladri Chakravarti. I am the practice lead here for legal and corporate law practices here at Tax Mantra Global. And to speak a little bit about Tax Mantra, what we do as a service, we are a 360-degree tax and legal compliance firm, having our presence in US, Singapore, India. In India, we have our offices in Kolkata and Bangalore, and we are spreading our wings in Dubai as well. So, and to give a little bit of highlights about the client side of Tax Mantra, what we do. Uh, we do a lot of due diligence, helping investors in conducting due diligence in their target companies. Then we do global structuring as well, cross-border taxation, uh, and transfer pricing. Uh, and if you wish to set up your entity abroad, like you plan to go out to Singapore, you plan and go out to US. The global entities who are having their presence abroad, if you're looking to come back to India, set up your entity in India, we help on those aspects as well. So we provide a holistic kind of a services, mostly focused towards startups. And interestingly, recently we have got a couple of startups who were acquired by Razorpay, and then we have a very recent analytics company which was acquired by Adani Enterprises Limited. So to start with, let me quickly jump on to the contents of the topic and what are we going to cover in it. So to give a little bit of glimpse about how the Indian startup ecosystem looks like, a known fact, we are the third largest startup ecosystem in the world, just after US and China. We have recently surpassed UK from that position, and we have come to the third position. In terms of numbers, if we speak, India is currently at the fourth position with 107 unicorns, uh, with a total valuation of $340 billion. uh, I mean, if you talk about the segments, the industry that startups are operating out of, we have e-commerce, fintech, edtech, consumer services, D2C, everything. Uh, Another important aspect, because it's more related to the topic that we are going to cover, more than 30% unicorns from India have gone international. And over 42% startups are looking to expand and tap the global markets just in 2022. So that's a pretty high number. If we see how the startup ecosystem is growing, is maturing in the Indian scenario, and why this particular topic is very important looking from this perspective. So because we are generally covering the entities who are trying to come to India and the entities who are trying to go abroad from India. So what are the so the entire transactions are only related to the foreign transactions. So what are the aspects that we need to really look into? One is the FEMA and the RBI laws, very important. Income tax laws and transfer pricing laws. The double taxation avoidance agreement between two countries, because these are bilateral agreements between the two governments. So you don't pay double tax in two nations when an exit happens, or whatever sort of transaction happens when there is a tax liability. You don't end up paying a double tax in both the countries. So there are double taxation avoidance agreements. uh, it's important to also look into the perspective, look into the entire structuring from the perspective of place of effective management, uh, which is also called POEM. And then we have general anti-avoidance rules. So the ideal way, basically, when a structure is being done, the income tax department, have a high chance of actually looking into the entire structure, and they want to check if there has been any uh, ill intention behind the structuring, if there has been any sort of intention just to avoid taxes, paying taxes in India. So they try to leave that corporate veil and see the entire nature and the underlying reason behind that particular structuring. So general anti-avoidance rule, and also the rules and regulations of the country where the investment is done, or from where the investment is coming. So a very quick example would be like, if an investment is coming from Pakistan to India, that goes under the comes under the lens of several departments, including Ministry of Home Affairs as well. So it's not very it's not a open route wherein people can invest from Pakistan to India. There are several other restrictions as well. So we need to check the rules and regulations from where the investment is coming, or in which country the investment is going. A little bit highlight about foreign investments. So what are the sectors where 100% FDI is allowed under automatic route? So that's more important, that whatever is covered under the automatic route. Although a lot of companies today which are coming up are in the segment of ITES, so wherein you have 100% automatic route, FDI covered under automatic route. But apart from it, you have agriculture, animal husbandry, biotechnology, medical devices, single brand retail trading, healthcare. So all these sectors you have 100% FDI allowed under automatic route. Uh, the other route is called the approval route, wherein you don't have, wherein there are segments or industry or sectors, to be specific, you don't have an automatic route. You will have to go under the approval route. In approval route, what you do is you basically take the permission before you actually get the investment. So you will have to make an application in the Foreign Investment Facilitation Portal, which is the FIFP, with all the necessary documents. These goes to the Ministry of External Affairs, Department of Revenue, Ministry of Home, as may be required. And then once the entire approval is received, then the investment can be received, which is FDI can be received. What are the changes? These changes in the FEMA law have been brought into some time back, not very late, but these are very interesting ones. Various sectoral limits in both automatic and approval route has been changed, such as manufacturing sector, single brand retail, etc. One of the major decision, one of the major notification that has come up on 27th April 2020 was, earlier in case of FDI, rights issue was usually not allowed, so you had to go for private placement. So after this notification, the RBI has actually allowed that non-residents can actually acquire shares uh, if the shares have been renounced in favor of them by someone who was an existing shareholder in the company, subject to compliance with the necessary regulations and reporting it accordingly to the RBI. So this was a very important notification, which has really helped a lot of startups and founders. So quickly going to the regulations and the compliance. So in these particular two regulations or reporting, I would say, are relevant or applicable when there is an FDI. So money coming into India. So there are two reportings that needs to be made. One, in case of issue of shares, which is called the FCGPR, you will have to file a form called FCGPR in case of issue of shares. And if there is a transfer of shares, so and then you have to file FCTRS. A little bit of difference between what is issue and what is transfer. Issue is the primary issuance from the treasury of the company. You are issuing fresh shares to an investor. And in case of transfer, this is more of a secondary transfer, wherein an existing shareholder who is having some sort of a shareholding in the company is transferring the shares to someone else. A major difference is in case of a primary issuance, the existing shareholders actually dilute their shareholding. So in equal proportion, whatever the percentage is being issued. In FCTRS, it is only the person's share which gets diluted, who is transferring the shares, because his particular kitty is getting decreased by that number of shares, whatever he is transferring. In terms of compliance, you will need valuation report from SEBI registered merchant banker or a registered valuer, and you will have to report it to the RBI while filing both the forms, both FCGPR, FCTRS. Then you have two important documents which are mandatory. So whenever the money flows into India, you will have to coordinate with your AD bank, basically the banker. AD bank is an authorized dealer bank. So your banker, they have to provide you with the FIRC and KYC. FIRC is the foreign inward remittance certificate, and KYC is the know your customer. So these two documents are very, very important when you report this transaction, because otherwise you will not be able to actually report the transaction. And these are the documents on the basis of which RBI will actually scrutinize the amount that has been received in the Indian entity, and then they approve that particular transaction. Uh, coming to the next part, this part I talked about when investment is received in India, which is FDI. Now the other side of the coin is when someone sends money outside India to actually acquire shares or any sort of securities. So which is called the overseas direct investment. So in overseas direct investment, again, you have two separate routes. One is the automatic route and the other is the approval route. And I mean, whatever happens, you will have to comply with the regulations, and you will have to report the transaction to the RBI in form ODI. Now, an important point here is you might be having an entity. Let me consider, and you have an entity here in India, and this entity is having 3 separate bank accounts, which is very much possible. But it is important that whenever a transaction happens from basically money goes from India to abroad and you are acquiring shares, all the transactions should happen through one single bank. So you might be having an account in X bank, Y bank, Z bank. You transfer the money, you acquire shares, you report it through the entire form ODI is being reported through the AD bank. Now, the first transaction that you did, you reported it through the X bank. Now you cannot, and in the second transaction, maybe after a year, you have done another ODI transaction, you have acquired shares in another foreign entity. Now in that event, you cannot go and do the reporting via Z bank, because I mean, the ultimate objective is the entire transactions that has been carried out should be routed through a single bank, wherein the RBI can actually get hold of those documents and scrutinize them. So it has to be from a single bank. This is very important point. A lot of entrepreneurs in the initial days might miss this, and this leads to a lot of complexities and can really land that particular company in trouble. Now, what is the so what is the limit, or how can the person residing in India can actually transfer the money? So the RBI has set a limit of ODI for Indian companies at 400% of the net worth of the Indian entity, as per its latest last audited balance sheet under the automatic route. For Indian individuals, you have a separate rule wherein resident individuals can send up to $250,000 in a financial year under the LRS route. LRS is like the liberalized remittance scheme. Through LRS, you have the rights to do both current account and capital account transactions. It is important that whenever those transactions happen, either through ODI, either through LRS, whatever it is, you will have to report the transaction through the ODI form. You will have to file annual returns in APR. You will also have to comply with the FLA, file the FLA return as well yearly. So wherein whatever transactions that you have done, if you have any kind of liabilities, assets, FLA is the foreign liabilities assets. So if you have any foreign liabilities of or assets, you actually need to report those transactions every year to the RBI by filing those returns. Now, we have almost got an idea about how the law looks like. What are the changes that is coming? Now, I'll go to the structuring part. First and foremost, the most important question that comes up to the mind of an entrepreneur is like, what is a preferred destination for entities? So I have an entity here in India. I'm looking to go global. So what is a preferred destination? So a lot of times entrepreneurs, they themselves decide that I wish to go to that particular destination, set up my office in that geography. But there are also instances when the founders are actually looking for opportunities, or maybe they are in a dilemma where to set up an entity. They have a couple of places in their mind, but which could be the best option for them? So how do you select this? And what are the preferred destinations? There can be n number of destinations. A lot of companies might wish to go and set up their entity in Estonia, in Malta, any in British Virgin Islands, anywhere. But what are the preferred destinations? I'm not going to get deeper into all those countries, but I would cover 3 countries here, which are preferred destinations at this point of time, from separate perspectives. So number 1, USA. I mean, USA is at the forefront of in terms of ease of doing business for startups. US has been a preferred destination for a lot of companies, and a lot of companies which have actually grown bigger have their base or head office in USA, but specifically in Delaware. The second important destination that has recently gained a lot of importance over last decade is Singapore. I mean, this has become a gateway to the Southeast Asia market, and a lot of startup facilities by the government has actually given a boost or an impetus to all these startup founders to actually have their entity there in Singapore. Secondly, in Singapore, you have a great benefit wherein, apart from USA, wherein investors are very comfortable in investing in a startup. The second, which would probably come to that place, is like Singapore, wherein investors are very happy to actually invest in an entity set up in Singapore due to no capital gain tax. The third place, which is recently emerging, is Dubai. And why Dubai? This is mostly for the startups working in the domain of blockchain, cryptocurrency, NFT, and metaverse. So these entities, Dubai is really trying hard to actually encourage those startups and come and set up their entity in Dubai, and they have got a lot of opportunities. They don't have strict regulations in terms of operating companies who are operating in the cryptocurrency regime. So Dubai is slowly becoming a hot destination for these startups which are operating in these sectors. Talking about the structuring part, there can be only two ways of structuring. So one, you have a parent entity in India and a foreign subsidiary. The second is you having a foreign parent and an Indian subsidiary. So when you have an India parent and a foreign subsidiary, you will have to comply with the ODI regulations, because the Indian company is going to acquire shares in the foreign entity, which means the India entity is purchasing the shares. So you are sending money abroad. So that particular sort of structuring will require you to comply with the ODI regulations. The ODI, the highlights or the mechanism of ODI regulations, I've already covered in my earlier slides. You will have to comply with the APR, which is called the annual performance report, and the FLA return as well, foreign liabilities and assets. So these are annual reporting that you need to do. The other part is having a foreign parent and Indian subsidiary, which most of the time happens. Uh, Interestingly, there is a major change that has been notified in August 2022, wherein earlier the entities were not allowed to actually have two layers of subsidiary. But now with this notification, which was released in August 2022, uh, step down subsidiary up to 2 years has already been allowed by the government. The important part here is, how do you set up a foreign parent and an Indian subsidiary? That requires a lot of brainstorming and a lot of understanding of the regulations, both from the foreign perspective and also from the Indian perspective. Because how the shares are going to be acquired by the individuals or the body corporate out there in US or maybe in Singapore, and then that company having a subsidiary back in India. Now, why do the people have a subsidiary back in India? Is pretty simple, because of the low cost in hiring resources, and you can have actually have your back office here back in India, hiring all the employees who do the back office stuff, and the entire uh, objective of having a parent entity head office, so that you have a global presence and you have also have the confidence of the investor to put the money out there in the foreign entity. So that's the entire idea of having a foreign parent. So it's very important that when we set up a foreign parent and an Indian subsidiary, we need to really check about the structure and how do we do that structuring. And that needs to be done from day one itself. If you're really planning to have a foreign parent and an Indian subsidiary, that cannot happen after a period of time has already passed by, wherein the Indian company has already established a big amount of valuation. So the whole idea is to do it in such a way that both the entities remain in a friendly state, and we don't get into such a situation wherein the entire structuring becomes a very complex one. However, even if a complex situation has already arisen, the structuring can be done, but that is not really encouraged. If you're really planning to do it from day one itself. Get in touch with the consultants how to do that, and find out a way what would be the best suitable structure. Talking about the common queries, obviously, in terms of structuring, there can be n number of queries which would require uh, a discussion probably for around hour two or so. That even is not enough, because one answer to one question will give rise to another question. So there are n number of questions, n number of answers, and it requires repeated discussions, repeated sessions of discussion with the founders, and understanding the business nature as well to structure that. But apart from that, what are the common queries? One, can an Indian resident hold shares outside India? Definitely, yes. You can hold shares outside India. Comes under the LRS or ODI regulations. You will have to comply with those regulations, and you can do that. Uh, the procedure of reporting differs from individual to a body corporate. The second most important thing, and people have more so started asking this question after 2020, the COVID scenario, which is it possible to open a bank account abroad remotely? Yes, definitely you can open a bank account. There are a lot of conventional bankers who actually don't allow opening a bank account remotely, but there are also several other banks, large banking corporations as well, who actually help you in opening a bank account abroad. So we have tie-ups with a couple of banks, partnerships, uh, and they will help you in opening your bank account uh, abroad remotely sitting here in India. So one of the banks being HSBC, we work with them closely, and a lot of our clients have actually been able to tap that part wherein they have been able to set up their bank account remotely. So we have helped a lot of startups of late. Talking about what is the importance of having a right structure. Now, this part is very important, because that the entire webinar or this session is all about structuring an entity and how to understand what is the importance of this. So this slide is very important from that perspective, wherein you really need to understand what actually determines those right structuring, and how do you really come to a conclusion if that is particularly a right structure or not, or in terms of both setting the geography that you are planning to set up. Number one is in business operations. So a lot of time, most of the times, one of the major reason why an entity goes foreign uh, is because of the requirement to increase the reach. So you have your foreign customers, you have market requirement to have your office outside India, and you need an office there. So that is somewhere wherein you will have to set up an office. Now when you set up an office, it's ideally, it's just, so at times there are obvious reasons when you have just a sales office, but most of the times you actually set up a lot of startups actually set up a foreign parent entity or a foreign subsidiary entity, depending on the requirement of the business, and how do you really want to set it up. So ease in business operations is one of the reason. The second is regulatory regime. So different countries have got their own set of laws, and you actually need to realize which law suits you the best. Probably, a classic example would be a cryptocurrency company, a company which is crypto based. Uh, you might be interested in setting your entity in a particular geography which is very startup friendly, but then you will also have to see if that particular nation is crypto friendly or not. It might be a startup friendly for a number of sectors, but not for crypto. So if it is for crypto, and if you're working in a crypto industry, then you need to identify that particular industry, that particular geography wherein you will have the maximum benefit, wherein you have low compliance regime, wherein the entire regulatory process is hassle free, and you do your business in a right way without actually uh, breaking any law. So regulatory regime is very, very important when you decide your structure. You need to see which regulatory regime or which nation is providing you the right sort of environment to do the business. The third is fundraising. When it comes to fundraising, a lot of investors would like to put their money in that particular geography wherein the complexities are less. It's important they, so why the major reason behind why an investor puts in the money is they want to earn some profit out of it. So day one or day two or day three, some or the other day, they will take an exit from the company. And at the time of exit, it is important that they should be able to take an exit without any barriers. So that is very important. So fundraising as an activity plays a crucial role in deciding the geography and also the structure. So having a parent here in India and a subsidiary outside India might be beneficial for X company, but not for the Y company, because the investors in that particular company might want the parent entity to sit abroad, maybe in US, maybe in Singapore. The fourth one is repatriation. Again, a very important point. The investors, they might be coming from different geographies, different nations, different countries. So what happens? So if some investor is putting the money in India, and that investor is coming from Canada, so that investor should be able to actually repatriate the money. They have put in the money. Now they wish to take. They have taken an exit. They wish to take the money abroad after the exit. So is the mechanism, is the compliance regime easy for them to take the money abroad or not? So that plays a very, very important role when you entirely decide the structure and you plan to bring the investors into your company who are going to take an exit some of the other day. And the idea of the entrepreneurs or the business is to make the life easier for those investors who are actually putting in the money, and not make it a cumbersome process. The fifth and the last point is taxation. Definitely, I mean, everybody is, if it doesn't matter if it is an investor or a founder, everybody wants the tax structure, the tax planning to be in such a way which is optimized. So nobody wants to pay high tax when they take an exit, or whatever the situation may be. Nobody wants to pay a higher tax. So you need to plan the structure in such a way wherein the tax applicability is reduced, and within the ambit of the law, and the plannings are done in such a way that it becomes a very friendly startup to actually invest, a very friendly startup to actually reach out to several places, do businesses, and work out the entire structure. So that brings us to like the end of the webinar, and I've tried to cover a lot of aspects here. There has been a notification in August 2022, which I have already highlighted, wherein 2 years of subsidiaries are already allowed. In terms of gifting, there has been some sort of changes, which was earlier open-ended. Now the government has actually notified about the gifting part, who can do, who cannot do, how the gifting needs to be done, what are the compliances uh, at the background of the gifting structure. So gifting is an area has been now brought under the umbrella of the compliance mechanism. So it's not open-ended anymore. So if you plan to do a gifting, make sure that you are in touch with your consultant and figure out the right way of gifting shares. That is very important. In terms of setting up entities in Singapore or in US or in Dubai, how do you set up, and back then that company having its subsidiary back in India, how do you do that? I mean that has got their own set of regulations. You will have to comply with that. Again, I would say get in touch with your consultant and try to identify the right structure, because if you have messed up the entire structure, I mean the entire business would go into vain, because by the time the department of would come up catching you on non-compliance part, you would have actually made some business in the company, and uh, penalties can be like hefty penalties, because new laws, the government is getting stricter in handling these cases. So yeah, we at Tax Mantra, as we speak here, we have been doing number of structuring these days. uh, we have on our table more than 10 structuring, which we are doing currently at this point of time, all in US, Singapore, and a couple of them in BVI as well. So with this, I we have come to the conclusion of this session, and if anybody has any questions, you can definitely reach out to us. You can mail us at info@taxmantra.com. You can also WhatsApp us, reach us through phone, and definitely we will try to help you out on whatever requirements you have. Uh, with this, let me end this session, and see you soon on another interesting webinar. By the time, take care. Thank you.